MFS stands for Massachusetts Financial Services. We're a firm based in Boston. We were founded in 1924. We manage approximately $630 billion in funds under management. We've been in Australia for over 20 years. We're really a global firm with a culture based on collaboration and integrated decision making. Our investment team are extremely well aligned with the investment objective of the fund. Our incentive programs are based on 3, 5 and since inception performance numbers. And a lot of our investment team are awarded equity, which vests over a 5-year period. So very strong alignment over the longer term objectives. The investment objective of the fund is to outperform the MSCI World Benchmark by 2% over a full investment cycle. The investment philosophy underlying this strategy is really a GARP approach. So we're looking for growth, but we don't want to pay too much for it. We believe that by bottom-up fundamental analysis, our analysts are able to uncover companies that are able to sustainably grow those earnings year after year, and we want to just make sure that we get them at the right price. We feel that the market often undervalues the ability to compound those earnings. We have a team of over 60 equity analysts located around the globe focusing on that bottom-up fundamental research. We organise them into 8 sector teams, and we actually have an integrated research approach. And what I mean by that is we have our quantitative analysts and our credit fixed income analysts discussing ideas with the equity analysts to really uncover those little gems that then make it into the portfolio. The analysts then discuss on an ongoing basis with our portfolio managers, who, by the way, were all analysts at MFS, to really decide on which are the best ideas to go into the portfolio. The key risks to the strategy are all clearly laid out in the PDS, but one of the key ones that I think is this strategy will often underperform in times of market exuberance when the markets aren't really being driven by the fundamentals that are driving these companies. One great example of that is the late 90s, the tech bubble. We didn't get involved in that. We actually underperformed for a couple of years, but then our focus on quality companies allowed us then to deliver through the cycle and often preserving capital as we go. Country allocations are really an output of our bottom-up process. We're investing in global quality companies, so often we don't pay that much attention to where they're domiciled. A great example of this is emerging markets. It may look like we're underweight emerging markets, yet a lot of our global companies are deriving a lot of their revenue from the emerging consumer. So we focus much more on revenue as opposed to domicile. With the global equity strategy, we also offer a fully hedged version for those clients that just want to hedge away all currency risk. This doesn't mean that we don't look at currencies. Each and every company that we invest in, our analysts do a lot of stress testing around both the revenue and the expenses to really gauge to what extent they are exposed to currency fluctuations. Some of the key features of this strategy are style, consistency. It is that GARP. Buying companies at the right price that are growing their earnings in a sustainable fashion. Also, our strong risk-adjusted returns. This strategy has been in Australia for over 20 years and we've delivered consistently throughout that time period. Also, access to our global research platform we think is key. But last, by definitely no means least, is strong risk management at our firm level, at the portfolio level, but perhaps most importantly at the stock level. We know the companies that we own on behalf of our clients.